The defining economic challenge today is that the cost of living rises faster than most people's incomes, eroding the promise of prosperity. People work harder than ever, yet life grows more expensive. Housing costs soar, wages stagnate, and debt hits records. Across the developed world, millions of people are asking, why does everything suddenly feel unaffordable? In the United States, Europe, and other developed countries, the growing gap between rising living costs and stagnant incomes is redefining affordability and reshaping economic security. Rising housing costs have impacted affordability, while debt has reached record levels and basic expenses outpace incomes. Debt is now at a record high. Basic expenses are climbing faster than incomes for many. Especially for younger generations, financial stability is increasingly uncertain. Buying a house, saving for retirement, or even maintaining daily spending is now a greater financial burden than it used to be. This change did not happen overnight. It developed gradually over decades, driven by rising costs and economic shifts. This is how the Great Affordability Crisis happened, and how the basic costs of daily life have quietly outpaced income growth, reshaping economic security for millions. The increase in the cost of living is one of the most noticeable transformations of contemporary economies. This is usually measured by inflation, which is the easiest method. The Consumer Price Index, which is a popular measure of inflation in the United States, has risen by over 240% since 1980. However, general inflation does not tell the whole story. Basic elements of modern life are now simply too costly. In healthcare, costs have increased dramatically. As of 1990, the United States spent about $714 billion on healthcare. By 2022, it had increased to over $4.5 trillion. A similar trend has affected education as well. College tuition in the United States has been increasing at a rate well above inflation. Over the last 40 years, the cost of attending a public university has risen at a rate 3 times the general rate of inflation. For many, higher education has become a major financial burden, requiring loans before careers begin. And then there is housing. Housing has become one of the major financial problems for households today. Based on long-term housing statistics, U.S. homes have risen by over 300% since the late 1980s. House prices in most cities have risen so much that even some middle-income families cannot afford them. Rising costs aren't the only cause. Wages are a crucial factor in this crisis. To understand the reasons this affordability is a challenge, we must look to wages. For most of the 20th century, economic growth meant higher wages for workers. As productivity grew, employees earned more and lived better. However, in recent decades, the previously strong link between how much workers produce and how much their wages grow has weakened. Productivity of workers in the United States has grown by approximately 64% since 1979, meaning workers produce much more value per hour. But average wages have not increased at the same rate. Employees now generate more value than before. However, during the same period, average hourly pay has increased by only 17%, highlighting a growing gap between what workers produce and what they earn. This widening productivity wage disparity is one of the most significant economic changes of our time. To put it simply, while the economy itself has continued to grow, however, financial benefits from that growth have not always been evenly distributed. For many, income growth has not kept pace with rising costs. The result is a gradual destruction of purchasing power. Many families nowadays have 2 incomes, where a household used to be serviced by one. It seems increasingly hard to maintain the same standard of living. With higher costs and slow wage growth, households turn to debt to bridge the gap. More households now use debt to fill financial shortfalls. Debt now defines modern financial life. Governments, corporations, and households worldwide have borrowed like never before. By 2023, the world had over $307 trillion in debt, an all-time high. At least in the United States, household debt exceeded $17 trillion. This includes mortgages, student loans, credit card loans, and car loans. Debt is a major issue in today's economies, affecting growth and stability. Debt helps people buy homes, pay for school, and invest in their future. More borrowing brings more debt. Monthly payments rise. Interest costs rise. There is reduced financial flexibility. Debt may shift from asset to burden over time. For most households, debt enables living standards to be maintained as wages struggle to keep pace with costs, and no real estate market is more exposed to this dynamic than the housing market. Housing is at the heart of the affordability crisis. For most families, buying a house is the biggest investment they will ever make. However, in recent years, the housing market has become harder to get into. The average price of houses in the United States stood at approximately $222,000 in 2012. By 2023, that figure had climbed to over $420,000. In the meantime, mortgage rates have been changing drastically. Interest rates were at an all-time low during the pandemic, and borrowing was relatively cheap. However, by 2023, mortgage rates had reached over 7%, significantly raising the monthly payments for new buyers. High home prices and rising rates have made housing less affordable for decades. Young families today require years to save a down payment compared to previous generations, and in most cities, owning a home has become a luxury for middle-income earners. This is not the only trend in the United States. In fact, the affordability crisis is not limited to one country. In most developed countries, housing prices have increased faster than incomes. Canada, the United Kingdom, Australia, and most cities in Europe have witnessed a phenomenal rise in housing prices. According to international housing price data, home values in developed economies have been rising over the last 20 years. Several strong forces help explain this trend. The demand for housing has grown due to population growth in urban centers. In most cities, supply is limited, which has slowed new construction. Interest rates over the last 10 years were low, which stimulated borrowing and increased asset prices. Building costs have also raised new home prices. All these forces have transformed the housing markets in the developed world. As a result, the costs associated with everyday life have shifted dramatically. These forces have transformed daily economic realities. At its core, the affordability crisis results from a persistent and widening gap between the cost of daily life and income growth in developed economies. It grew over decades, marked by higher prices, slower wage growth, rising debt, and costlier homes. For millions, this persistent affordability gap signals that the economic system no longer delivers stability or opportunity as it once did. Given these dynamics, it is not clear whether governments and policymakers can solve this challenge. But one thing is clear. Across developed nations, the widening cost of living gap increasingly outpaces institutional efforts to address it. The continued rise in living costs over incomes will define the economic future for the next generation.